Finance News now. Here's reporter Rachel Pupazzoni. So, Rachel, our market has been shaken today by movement in US Treasury bonds. What's happening?
Yeah, we've seen our market fall more than 1% and all kinds of falls, in fact, for commodities as well. Now, US Treasury bonds yields are at significant lows. Treasury bonds, in simplest terms, are when someone invests with the US government. The yields or profit on US 10-year Treasury bonds have fallen, bringing bonds below zero. That's the first time they've entered negative territory since 2016, and now this has led to the 3-month 10-year Treasury curve to invert. So the profit on a 10-year bond is less than that on a 3-month bond. This is not the norm. When the 3-month 10-year curve is inverted, it is a reliable predictor of US recessions. Now, the last time that happened was in 2007, just before the global financial crisis. To talk about this further, I'm joined by a global market strategist with JP Morgan, Kerry Craig, from our Melbourne studio. Kerry, thanks for joining us. How significant is this?
Good afternoon. Well, it is significant, but it has been expected for some time. As you rightly say, when the yield curve does invert, as it has done the end of last week, that can be a reliable signal of a recession to be forthcoming. However, what the yield curve inversion doesn't tell you is exactly when that recession might occur. Over the last 7 times that yield curve has inverted, it's taken on average about 14 months for the recession to actually show up. So while we watch this signal as one that says that growth is slowing, we have to watch and see if it persists to really say we'll see that recession eventuate.
And of course, there are different Treasury yields. We're talking about the 3-month and the 10-year relationship. What are others doing?
A similar situation. Obviously, we look at sometimes the difference between the 2 and 10-year yields, or even the 30-day and the 5-year, and they're all telling a similar story that growth is slowing around the world, so therefore inflation expectations are coming down as well, and that's why you're seeing these yields fall. It was compounded last week by the Federal Reserve's statement, which was very dovish, the fact that they've ended their quantitative tightening process, or will end that this year, and they're not seeing any further rate hikes for this year. It just goes to push towards the idea that there is some weakness in the global economy, and central banks are very concerned about a policy error that might see them tighten heading into that weakness and creating that recession.
As you point out, it could be some time away before that happens, but what could the implications be globally?
I think for us, it's another thing that points towards the slowdown in the global economy. We've had very mixed economic data come out this year, and most notably last week, we had some very weak manufacturing data from the Eurozone. 2018 was a year we had fiscal stimulus in the US, we had very good growth around the world, and it sort of led to a higher growth rate. And this year we're seeing a lot of that unwind, as well as those concerns about US-China trade relationship, the Chinese growth outlook and how much stimulus we'll actually see. And so naturally we think about those factors in the combination of the fact that this is a very prolonged economic cycle, just saying that growth actually should be slower. It doesn't need to be a recession, but we think it actually will be sort of 2% growth rates instead of the 3% we saw last year. And on the back of that, we should think about equity markets that are going to have rather unaspiring returns in contrast to what they've had in the past.
And we've seen that today with pretty significant falls across the ASX, across all sectors.
Absolutely. I think to see that turn around would need to see some of the economic data start to improve, and that could happen if we do get a reconciliation between China and the US, for example. A lot of those trade numbers and that business sentiment might start to lift, and that would need to flow through into earnings expectations for the corporate world, and those expectations have been declining over the course of this year. Perhaps they're starting to flatten out a little bit, but we need to see them rise again to say we see that earnings growth that people really want when they're buying into equity markets.
Kerry Craig from JP Morgan, thanks so much for coming in.
Thank you.